EPK Capital presents Daily Brief for the 3rd of September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Where the headlines tell a story of a turbulent day, but the underlying numbers reveal an even deeper and more unsettling narrative. Today was a day defined by paradox. We saw signs of robust economic health in the United States, yet this good news sent a chill through global markets. We witnessed an unprecedented political challenge to a key pillar of the U.S. financial system, pushing a traditional safe haven asset to a record high. And we saw a digital asset market, often known for its volatility, show surprising resilience, but with a stark and telling divergence between its two largest players. The big questions on every investor's mind are: why did a strong jobs report lead to a broad-based market sell-off? What does a legal battle in Washington have to do with the price of gold? And what can the curious case of Bitcoin versus Ethereum tell us about the future of institutional capital? The day's events were not random, but rather a confluence of conflicting signals that have tested investor resolve. The answers lie in connecting the dots between macroeconomics, politics, and shifting investor sentiment. The day in numbers, a global market retreat. The day's sentiment was one of caution and retreat, with a significant slide across major global stock indices. The U.S. market, in particular, experienced its worst day in nearly a month, with all three major indices closing in the red, a reaction that appeared to be fueled by a blend of macro data and rising bond yields. The S&P 500 led the declines, shedding 44.72 points, or 0.69%, to close the session at 6,415.54. The Dow Jones Industrial Average followed a similar trajectory, dropping by 249.07 points, a 0.55% decrease, finishing at 45,295.81. The Nasdaq Composite, the most sensitive to shifting interest rate expectations, experienced the steepest fall among the majors, declining by 175.92 points, or 0.82%, to close at 21,279.63. The disproportionately larger decline in the tech-heavy Nasdaq Composite was not a coincidence. It reflects a fundamental market dynamic. When bond yields rise, investors become less willing to pay high prices for stocks, especially the high-growth, high-valuation technology companies that dominate the Nasdaq and S&P 500. The valuation of these companies is based heavily on future earnings, and as the risk-free rate of return offered by bonds increases, the present value of those far-off earnings is diminished. The day's events, from the strong jobs report to the escalating political drama, all served as signals that interest rates might not fall as quickly or as far as investors had hoped, a direct causal link that explains why technology stocks like Nvidia and Amazon were among the strongest forces pulling the market downward. The selling pressure was a global phenomenon, echoing across continents. European markets slumped, with Germany's DAX losing 2.29%, the UK's FTSE 100 falling 0.87%, and France's CAC 40 down by 0.70%. Asian markets, which had a more mixed finish, also felt the pressure, with Japan's Nikkei 225 dropping 1.00%, China's SSE Composite Index slipping 0.82%, and Hong Kong's Hang Seng Index falling 0.43%. Beyond the indices, specific stocks had their own unique narratives. On the decliners' side, alcoholic beverage company Constellation Brands tumbled 6.6% after it cut its full-year guidance and reported a slowdown in beer sales. Packaged food giant Kraft Heinz also saw a significant drop, falling 7% after announcing a plan to split its North American grocery business from its sauces and spreads unit. Conversely, on a positive note, PepsiCo shares rose 1.1% on the news that activist investor Elliott Investment Management had built a substantial stake in the company and was pushing for portfolio changes. Biogen also saw a notable gain of 5.6% following the FDA's approval of an injectable version of its Alzheimer's treatment, a development expected to improve patient access and convenience. The macroeconomic tug-of-war. The most compelling part of the day's story lies in the paradoxical reaction to new economic data. The prevailing market concern is not necessarily a looming recession, but rather the path of Federal Reserve interest rates. Investors are keenly watching for any sign that the Fed will be forced to cut rates aggressively, which would support asset prices and borrowing. This is why the release of the latest economic reports created a state of flux and uncertainty. The highlight of the day was the U.S. non-farm payrolls, NFP, report, which showed a robust increase of 250,000 jobs in September, a number that exceeded market expectations. 8. While a strong jobs report typically signals a healthy economy and would, in a normal environment, be seen as bullish, the current market context twisted this narrative. The market's interpretation was that this strong job growth provides the Federal Reserve with less urgency to begin a rapid series of interest rate cuts. This robust economic data reinforced the market's belief in the Federal Reserve maintaining a hawkish or more restrictive policy stance, while the CME Group's FedWatch tool still indicates a 90% chance of a 25 basis point rate cut at the upcoming September meeting. The strength of the labor market complicates the case for multiple or jumbo cuts in the months ahead. The market is now pricing in a slower, more cautious path for future monetary policy, a factor that put downward pressure on equities. In stark contrast to the strong jobs data, the manufacturing sector painted a bleaker picture. The August ISM U.S. manufacturing PMI came in at 48.7, falling short of the 49.0 forecast and marking the sixth consecutive month of contraction. 5. The report from the Institute for Supply Management highlighted that tariffs and global uncertainty were making business conditions chaotic. This conflicting data created a macroeconomic tug-of-war. Is the economy resilient, or is it facing a slowdown? This conflict of signals manifested directly in the bond market. The 10-year Treasury yield, a key benchmark for borrowing costs, climbed to 4.27% from 4.23%. This increase can be attributed to several factors. The strong jobs data reduced fears of a hard landing for the economy, leading investors to sell safe haven bonds and move into riskier assets, which pushes bond prices down and yields up. At the same time, the rising U.S. debt pile and ongoing geopolitical risks also put upward pressure on yields. This rise in the risk-free rate makes the dividend yields and future earnings of stocks less attractive on a relative basis, creating a direct headwind for equities and contributing to the day's broad sell-off. 1. The bond market, in essence, was acting as a canary in the coal mine, signaling the true underlying risk sentiment. The political undercurrents, a threat to the monetary system. Adding another layer of uncertainty to the market was an unprecedented political and legal drama unfolding in Washington, one with foundational implications for the U.S. financial system. President Donald Trump announced his intention to fire Federal Reserve Governor Lisa Cook, citing allegations of mortgage fraud. The significance of this move cannot be overstated. It marks the first time in the Fed's 112-year history that a U.S. president has attempted to fire a sitting Fed governor. In response, Governor Cook has filed a lawsuit to block her dismissal, arguing that the allegations are merely pretextual and are being used as a cover to undermine the independence of the Federal Reserve and install a more politically aligned appointee. This legal battle is expected to be a landmark case, with many legal observers anticipating it will be decided by the Supreme Court and could fundamentally redefine the central bank's autonomy. The market's reaction extends far beyond the details of a single legal case. The move is viewed as an escalation in the assaults on the Fed, and economists are warning that the institution's independence now hangs by a thread. The cornerstone of modern central banking is its insulation from political influence, which allows it to make unpopular but necessary decisions, such as raising interest rates to curb inflation. The market fears that if the Fed becomes an arm of the White House, it could be pressured to keep rates artificially low for short-term political gains. This could lead to a long-term erosion of confidence in the US dollar and financial markets, potentially creating sustained inflationary pressures. The direct consequence of this political uncertainty was seen in the performance of traditional safe haven assets. The price of gold, a classic store of value in times of distress, rose to touch yet another record high. This rally is not simply a function of interest rate expectations. It is a direct response to the mounting geopolitical and economic uncertainty and the new, unprecedented concerns over the Fed's independence. When trust in political and financial institutions is called into question, investors seek out assets that are outside of a government's direct control. The capital flows into gold reflect a market that is already pricing in the potential for long-term systemic instability. In a market defined by sell-offs, the digital asset space showed surprising resilience, though a closer look reveals a significant divergence in investor preference. The global crypto market cap remained strong, posting a modest increase of 2.00% to 2.01% over the last 24 hours, with the total market capitalization standing between $3.84 trillion and $3.92 trillion. Bitcoin, the market leader, demonstrated remarkable strength. Its price gained momentum, trading around the $110,700 to $111,000 range, representing a daily gain of 0.29% to 2.10%. The primary driver for this resurgence was not retail hype, but significant inflows into spot Bitcoin ETFs, which registered $333 million in net investments in a single day. This institutional participation, with inflows into funds from major players like Fidelity and BlackRock, indicates a key inflection point in the crypto market's maturation. Bitcoin is no longer viewed solely as a speculative asset, but is increasingly being legitimized as a viable asset class for institutional capital, a macro hedge against both inflation and the very political and economic uncertainty seen in traditional markets. The ETF mechanism provides a frictionless on-ramp for large funds to gain exposure to this new asset class without the operational challenges of holding the underlying asset. In contrast, Ethereum, the second largest cryptocurrency by market capitalization, was left behind. While Bitcoin rallied, Ethereum traded around $4,300, reflecting a daily decline of 1.32% to 2.34%. This underperformance is directly tied to the flow of institutional money. While Bitcoin ETFs saw substantial inflows, Ethereum-based funds experienced $135 million in outflows. Furthermore, analysts point to its technical struggles, with the asset caught in a short-term downtrend and a lack of clear directional strength, while preparing for a critical testnet transition. This divergence between the two largest digital assets suggests that the crypto market is maturing and segmenting. Institutional money is showing a clear preference for Bitcoin's simpler, more straightforward investment thesis, that of digital gold and a macro hedge. In contrast, Ethereum's more complex narrative as a platform for decentralized applications, coupled with its technical hurdles, has caused institutional capital to flow away from it. This shows that the market is becoming more discerning, with capital being allocated based on distinct investment theses rather than a single, monolithic crypto bet. The concluding synthesis. The market's performance today was a masterclass in complexity and nuance. A broad-based global sell-off, which at first glance seemed to be a simple risk-off event, was in fact the result of a paradoxical reaction to an economy that is too strong for the comfort of investors hoping for aggressive monetary policy easing. The robust jobs report and a surprisingly upwardly revised GDP figure served as a stark reminder that the Federal Reserve may have no reason to rush toward deep rate cuts, a reality that puts pressure on asset valuations. This macroeconomic tension was amplified by an unprecedented political challenge to the Federal Reserve's independence, a threat that sent investors scrambling for the safety of traditional havens like gold. The day's events underscore a fundamental and ongoing tension in the market: the perception of widespread fragility, fueled by negative headlines and geopolitical risks, versus the reality of underlying economic and corporate strength. The market is more resilient than it appears on the surface, but its direction remains highly sensitive to political uncertainty and the future path of monetary policy. The curious case of the cryptocurrency market further highlights the selectivity of modern investors. While the broad market retreated, a flight to quality occurred within the digital space, with institutional capital pouring into Bitcoin while shying away from Ethereum. This signals a maturation of the digital asset class, which is now being viewed with distinct investment theses for its different components. Looking ahead, the market will remain fixated on Washington, watching for developments in the legal battle that could redefine central bank independence and for any new comments from political figures that could escalate the narrative. The market's future will be determined by whether the reality of economic strength or the perception of political and geopolitical risk wins out in the battle for investor sentiment. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.